Greetings. My name is Lincoln Rice, and I am the coordinator for the National War Tax Resistance Coordinating Committee, which we often refer to as NUTRIC or NUTRAC for short. This is a War Tax Resistance 101 session, so if you're looking to learn more about war tax resistance and refusing to pay for war and U.S. militarism, you are at the right place. Some disclaimers before we get into more specifics. Some methods of tax resistance are not legal, and anyone who attempts them should be prepared to face the risks of civil disobedience. Government laws and policies are subject to change, hence we update these videos from time to time. This one will be taking into account some of the changes that happened to tax law and tax code when Trump signed his new bill on July 4th. War tax resistance counselors are those helping people figure out, what path is right for them in resisting taxes for war. We're not here to help people fudge, cheat, or employ gimmicks. It's to help people figure out what's best for them to follow their conscience. I do have a background in accounting. I have my bachelor's degree in accounting, but most people who share this information may not be accountants, and I'm not a financial advisor or a lawyer. Um, I'm here more just to share the wisdom of decades of experience from people who've been practicing war tax resistance. And almost everything I'll be sharing today it's not information I learned while getting my bachelor's degree for accounting. It's things I learned from people that have been a part of this movement for a long, long time. So, what is the National War Tax Resistance Coordinating Committee? It's a coalition of groups and individuals across the United States that have worked to support people who want to refuse to pay federal income taxes for war and violence. Before that, there used to be many local groups, and the national organization was started as to be more of a clearinghouse of information so that there wasn't duplication all over the place. But it's if you know of a local war tax resistance group, it's not that they're answerable to us. It's more that the national group is answerable to them. So we're very kind of grassroots type organization in that sense. Just to go through some basic background information, why people might do this. If you're watching this video, you're probably familiar with some or all of this already, but the United States spends more on its military than the next 10 countries combined. The Pentagon has never passed an audit, and you're probably here in some sense because of all of the waste that goes into military spending and all of the harm it causes in the international level and even within our own borders in the United States. But even when it comes to our own budget, every year the War Resisters League combs through the proposed president's budget to see how much of that budget is dedicated to past and present military expenses. So the last few decades, it's usually been somewhere between 40 and 50%, and that has rarely changed very much. So again, most of our resources that our taxes are being used for is for current and past military expenses. To expand on this a little bit, in addition to things like the military budget and war crimes committed by our own country, it's estimated that around 70 to 75% of the weapons used in Gaza um, during the invasion of Gaza by Israel were weapons that were funded by the United States and U.S. taxpayer money. Many people have started to think about war tax resistance and have started doing it because of the Trump administration, to some extent because of its authoritarian measures, but also these authoritarian measures have often been complemented with, again, supporting the invasion of Gaza and threatening to invade other countries, deporting people who may be, in unsafe conditions. And then also not only the legality of the deportations, but the morality of the deportations, border militarization, militarization of police, and the impact on the environment. The Pentagon is actually the number one user of oil in the world, the number one institutional user of oil in the world. And even though Trump has pulled out of the Paris Climate Accord, even when that accord was in force, it didn't apply to things like greenhouse gases that were created by the military. Those were exempt for reasons of national security. I'm not going to go through all these, but essentially, if we seem to have enough information about a civilization, we can find instances of war tax resistance. The earliest recorded instance on what's often known as the United States is an Algonquin tribe in the 17th century refusing to pay taxes for a Dutch fort. More recently, after the military coup in Myanmar, sometimes known as Burma, uh, we had millions of people there refusing to pay their utility bills because that was one of the main ways that the military government there was able to support itself and is still able to support itself. Which method of tax resistance is right for you? This is where it can, one of the negatives of war tax resistance is taxes are complicated. They can make people, confused. On the plus side, because there is so much that goes into taxes, depending on a person's individual situation, there's a lot of adaptability, and you can kind of custom choose a method that you're comfortable with based on your goals, risk tolerances, values, life situation, etc. But essentially, all the methods fall under two larger umbrellas. One is that you're refusing to pay some or all of your income taxes that you owe, and this is a form of civil disobedience. The other is that you make sure that you don't owe any federal income taxes. This would be the only legal method. For many folks, so this often for many folks involves lowering their income or maybe they're self-employed and they're making sure to have expenses that lower their income to such an amount that they don't owe any federal income taxes. For many folks, kind of the easiest guide for this is, are you making less than what your standard deduction will be at the end of the year? For tax year 2025, the standard deduction is now $15,750 for a single individual. For a married couple, it's 31,500. So if you make less than that, you are not going to owe anything. Um, but there are, depending on possible tax credits and deductions you might qualify for, you could make more than that, perhaps significantly more, and still not owe anything. If you're an employee, you might think, well, my federal income taxes are already removed from my paycheck. There's nothing I can do about it. So there is a method that for decades people have been practicing known as W-4 resistance. Your W-4 form, as opposed to your W-2 that lets you know how much money you made at the end of the year, your W-4 you normally fill out near the beginning of the year. It's an IRS created form, but it doesn't get returned to the IRS. It's just created for your employer to give to you to fill out, and then you give it back to your employer. And based on the information you put on that form, your employer will know how much money to remove from your paychecks during the year and send to the IRS for federal income taxes. And so on line 4B of that form is where you can put deductions. And if you wanted to inflate that form, W-4, if you want to inflate those deductions higher than perhaps they should be, that could lower your taxable, it could lower what your employer believes your taxable income would be and lead to your employer either taking less out of your paycheck or nothing out of your paycheck. We're not going to go into the specifics of how to fill out that form in this video, but we do have another video on that about that on our website, along with some written materials for depending on how much people want to dive into that. So I have the link on this slide, but also it'll be in the description of this video if you want to find that. But essentially, in the United States, we have this unique situation where you can control your federal income tax withholding as an employee. Then, when it comes time to file your income taxes, sometime between the end of January and April 15th, now you actually have the power if you want to pay it or not. So you could change your mind at that point. You could say, I'm uncomfortable with this. I don't want to refuse and put myself at certain risks, and you could just pay it. But now at least you have that choice. Um, if you already are getting a refund and it's because money is being taken out of your paycheck, you could use this to simply make sure that you don't get a refund, that not too much money is taken out of your paycheck, and that you're not giving the federal government this 0% interest loan. And actually, to do that would be completely legal. That's the purpose of the form, is so that at the end of the year, you don't owe and you don't get a refund. If you're self-employed, you already have it's up to you to send in a check, usually quarterly, to the federal government with not only your federal income taxes, but your what would be automatically withheld if you were an employee for Social Security and Medicare. And so now you're already empowered throughout the year if you want to keep sending in the same amount, or if you want to lower that amount, zero out that amount. When people are self-employed, depending on what type of self-employed person you are or who you're doing work for, your income might be reported to the IRS, which might lead to a future question, which we'll get to on another slide, of if you want to file or not. For some people, this depends on whether their income is being reported to the IRS. Um, so if you're working for a company, most companies are required to report income that they pay to contractors or self-employed people if they make more than $600 during the year. Um, they know how to send you the information and what information to send to the IRS, because when you first start working for them, they'll probably give you a W-9, which will ask for your name, address, and social security number, so that they can do that reporting. The July 4th bill that Trump signed is actually going to raise kind of the amount of money you need to make in order to have this be reported. So forever and ever, it's been $600. You'll receive the 1099 NEC, which is non-employee compensation. But starting next year for tax year 2026, they're going to raise that reporting threshold to 2,000. But if you're self-employed in this year, 2025, if you make 600 or more, you're going to have have those funds, probably that income reported. Um, there's also the gig economy, where you might end up getting a 1099. So the gig economy is kind of a special type of self-employed person. This is where you um, kind of it maybe it's easier to explain by example. If you're doing selling items on eBay or driving for Uber, you're not actually working for eBay or Uber. They're just a third party that connects you to who you do work for. So the seller, if you're on eBay, it connects you with the buyer, and if you're driving for Uber, it connects you with people who want to ride. The people that are buying and taking the rides are the people you're doing work for. eBay and Uber are third parties who uh, handle that income for a period of time. And that's the key. If you have a third party that handles your business income for a period of time, then under certain circumstances, they might report that income to you and the IRS at the end of the year on a 1099-K. For a long time, it was you needed to have it to get that threshold so it would be reported. You needed to have at least $20,000 worth of income and at least 200 transactions. During the last couple years, that had actually lowered significantly, but the bill that Trump signed on July 4th of 2025 put the old rule back in place immediately for tax year 2025. So it could be a way that if you're making less than $20,000 or having less than 200 transactions, that you could have non-reported income. But there is always the caveat, if that you could be under the reportable amount and the company you're doing work for still decides to report it. It's not against the law for them to do that, but um, it's one of those we're just not sure with this change if how many places will realize that they don't need to report, and if they'll choose to stop reporting on individuals that are making less than $20,000. I should also, this also this 1099-K would be inclusive of if you get paid, if you get business income on PayPal, through credit cards, through debit cards, through Venmo. Again, it's a third party handling your business income, and so it's also subject to this 1099-K reporting. The only kind of the only third party I'm aware of where it doesn't get reported is Zelle, because Zelle's kind of a wire transfer. It's like a check. Zelle never handles the money. It just literally transfers it from one bank account to another and never stops with Zelle. So Zelle isn't part of 1099-K reporting. So filing versus not filing, one you're a bit more seen, one you're a bit more hidden. There could be pluses and minuses for both. So filing, we'll start with that. You know that you're sending accurate tax forms to the IRS. If you do send it in a paper format, it allows you to send a letter of protest if you'd like to add that. It does make collection easier because for the IRS to collect, they first have to assess or determine your tax debt. When you file tax forms, that takes care of that step for them. As soon as they process your tax forms, now that's your debt has been assessed. Once your tax forms have been processed, though, it starts a 10-year statute of limitations. And after 10 years, if the IRS has not collected that money, they can take no action, no further action to try and collect that money. The only exception would be if you, on purpose, grossly understated your income or took deductions that you did not have a right to take. And so that would be considered tax fraud. There's no statute of limitations on that. Filing makes it easier to receive scholarships and health insurance subsidies through Obamacare. For health insurance subsidies, it's actually a requirement that you file in order to receive those subsidies. And if you're married, it's a requirement that you file married jointly. If you're applying for scholarships, it's not a requirement, but depending on who's handling your FAFSA or federal, financial aid application for it'll just depend if how flexible they're willing to be. The number one way that they like to verify income requirements for receiving financial aid for education is looking at filed income tax forms. If you haven't filed them, they might be open to verifying it in another way, but they might not be. It's up to whoever's processing your form. If you're not filing, we'd still recommend that you fill out your forms because if the IRS ever chooses to file for you and starts the collection process, they'll usually file for you in a manner that overinflates your income and would lead you to have a greater tax debt than perhaps you should actually have. So you could, if you have your tax forms filled out, you could dispute it if they ever file for you. Going back to the scholarship situation, we've had a number of situations where even if people didn't file, if they had the filled out tax forms to hand over to the person um, handling their financial aid application, they've often accepted that as proof of income. I guess they figured if you're willing to go through the time to fill out the forms, they're probably accurate. It does make IRS collection harder because now they need to actually fill out the forms for you. And with the IRS having so many budget cuts, they just don't have as many people to fill out forms first so they can determine the tax debt so that then they can start collection. Technically, there's no statute of limitations, or at least not until they would file for you, which may or may not ever happen. And there is an additional financial penalty for not filing. Myths about war tax resistance. We're going to go through some myths and then actual risks. So I will go to jail. This is a very common perception, but it's very rare. During the last 30 years, the only individual who's gone to jail where it wasn't a situation of tax fraud or kind of misrepresenting oneself on one's tax forms was Tony Serra in 2005, who was a lawyer. And that I'd say if you're a lawyer watching this, or perhaps a CPA, a certified public accountant, um, if they're going to charge you criminally and you've actually filed forms and been accurate on your forms, they would, it's usually the burden of the IRS to prove that you knew exactly what you're doing and knew exactly what the risks are. And it's easier for them to do that if you're a lawyer or a CPA. Otherwise, it's been extremely, extremely rare. In the United States for the federal government to criminally prosecute war tax resistors. They usually use what we refer to as their civil arm or civil division to try to collect. The IRS will take my house, car, or property. As we can see, that actually used to be common. If you know any war tax resistors from the 70s, 60s, 70s, or 80s, early 90s, there's a good chance you know someone who had a car taken, and in rare instances, they also did seize some people's homes. So, but there was a change in policy in the mid to late 90s, and now it's become extremely rare. We don't know of a war tax resistor who's had any physical property taken by the IRS since the mid to late 90s. It's usually something, this property seizure method is something that's reserved as a way to embarrass the uber rich into paying their taxes. The IRS will get the money anyways. So we know from their own reports that the IRS doesn't collect the majority of the money that is not paid. They refer to the gross tax gap as the difference between the amount of money they believe is owed every year and the amount of money that's actually collected. And at the end of the day, if you do the math, they believe that for any given year, they'll end up collecting about 12 or 13% of the unpaid tax debt for any given year. Now, on the individual level, if you're one of the unlucky few who they did start garnishing wages or seizing a bank account, because of penalties, um, that would be added onto the principal tax debt, you could end up paying more than you originally owed. But if we're kind of looking at the big picture, they don't collect most of the tax debt from most of the people. It's only a small percentage. And truthfully, this data is close to 10 years old. It's about 10 years old now. So they've had significant budget cuts since then. So the amount's probably even smaller. War tax resistors don't pay for things our society needs, so it's been a long-standing practice of war tax resistors who are refusing to pay a portion or all of their federal income taxes to redirect those to, individuals and groups that could use that funding that are underfunded. And many do this on an individual level, but in the New England area and in the San Francisco, Oakland area, there's two significant groups that each year accept grant applications from local justice organizations. And this past year, I believe the Bay Area group redirected around $80,000. So, for the IRS, this is truthfully a small amount, but for the groups that receive this money, it significantly helps them in their work. So, what are the actual risks? Um, First, letters. If you file, you will get a lot of computer generated letters. Many of them could be very, cause consternation, fear, and that's what they're meant to do. The letters are their best way, their most efficient way of getting tax money without really doing anything because there's no one actually on your case doing anything. But they will send letters. Social Security garnishments, they can take 15% of someone's Social Security. So if you're resisting and you're receiving it already, or you're resisting and then later on file, they might take 15%. They haven't been as good about this lately. It used to be an automatic thing, but since COVID, they're still struggling and haven't gotten back to enforcing Social Security garnishments. They may do a salary garnishment. They stopped doing these with COVID and they haven't restarted any with any war tax resistor that we know of. Bank account levies, we know of maybe since COVID, one or two people a year that this happens to, or they might go after someone's investment account or a bank account. There, with a salary, going back to the salary garnishment, they need to leave you some take-home pay. The take-home pay, if you're an individual, is around $1,300. If you're married, it's about $2,600 a month. If they're taking a bank account or an investment account, they can take up to the full tax debt if the money's there. Um, State tax refunds, those we've been hearing from folks are pretty common. If you have state income tax and you overpay and or do a refund, there's a very good chance um, they'll have a levy waiting with your um, state revenue department, and you'll just get a letter back saying that they've taken it. There is interest and penalties. Kind of a general rule of thumb is uh, over the 10-year statute of limitations, your tax debt will triple. So if you're resisting $100 right before it disappears at the 10-year statute of limitation time frame, it'll be up to 300. If you're resisting 1,000, 3,000, 10,000, it'll go up to 30,000. So you can at least have a sense of what that could be. Loss of healthcare subsidies, that's if you're a non-filer. Again, if you're a non-filer, it could be difficulty in getting student loans. Once you owe about $25,000, they may file a notice of a public lien with your local county courthouse, which in the past also affected some people's credit, but we haven't seen it affect anyone's credit since maybe around 2015. But the lien does go out. The main effect there would be if you were a homeowner and you were selling your home, before the bank pays you from whoever's buying your house, they would normally check with the county to see if you have any outstanding debts. And if they saw that, the IRS would kind of get first cut before they would give the remaining payments to you. And then a possible loss of passport, or at least the ability to renew your passport. Your passport wouldn't be revoked, but if you have what the IRS calls a seriously delinquent tax debt, it goes up every year, but for tax year 2025, it's $64,000. If your tax debt reaches that amount, they'll send a letter to you and the State Department stating that you can no longer get a new passport or renew your current passport. So, for people who either need to travel, love to travel, want to leave the United States at some point, you might want to keep that in mind if you know your tax debt would be growing. Community property states. So, this is something if if you're married or you're thinking of getting married, if you're in one of these gray states, and you had a spouse that either didn't want to be a war tax resistor or wasn't comfortable with it, you could file separately, which usually isn't advantageous for tax purposes, but you could file separately and it would keep the debt with the spouse who's the war tax resistor. You could have the significant assets, home, car, and all of that, even though they're not taking that right now, but in case policy would change, you could have assets in the name of the non-war tax resistor. Again, that you wouldn't be able to do this if you want to receive Obamacare subsidies because that requires that you file jointly if you're married. And also, if you're in these red states, these are called community property states. In those states, even if you file separately, the tax debt belongs to both spouses. So the IRS could go after either spouse if you're in one of those red states. In those red states, community property states, any debt or asset that is obtained by either spouse after they're married belongs to both spouses. So just something to be aware of. Lastly, just check out our website. It is huge. There's so much information there. It's all just available for free. Lots of resources. We have a newsletter you could sign up for that goes out every 2 months, a blog that goes out every week or so. Um, Tax day activities. We have conferences, sometimes on location somewhere, sometimes online. Um, so feel free to check it out. It's a good resource. It takes some time, explore, make sure you're comfortable with what you're thinking you might do. And there's also a list of war tax resistance counselors where there might be one in your state if you want to talk through some of these issues with someone before you make any decisions. That's the purpose of what we're here for as an organization, is to make sure you can make an informed choice and know what you're getting into. This resource list I'll also have down in the description, but it's our website, the W-4 resources if you're an employee and want to change your withholding, the contact counselors list, uh, email sign up for our newsletter. We host the website for the War Tax Resistance Penalty Fund. They're separate from us, but they're a mutual aid group where essentially when someone is collected upon, if you're one of the unlucky few that has a wage garnishment or a bank account levied, they'll pass the hat, and in most cases, if everyone throws in around $30, they'll be able to reimburse people, at least for the penalties and interests. They don't reimburse people for the principal amount that was taken out, the tax debt that you initially resisted, but they know that the extra hurt often comes from the fact that there's those extra penalties and interest. So in most cases, they've been able to reimburse people for those penalties and interest. We're also on Instagram, Facebook. Feel free to check us out, share our information. And again, thank you for taking the time to watch this video. We appreciate it and feel free to contact us if you have any questions or concerns.